I mean, think about it like this. If you break a major banking law in the U.S., um, a federal regulator is absolutely going to knock on your door.
Right, yeah, the FDIC or somebody.
Exactly. Or, if you manipulate the stock market, the SEC steps in.
Hmm.
It's this very linear, clear relationship.
Yeah, there's a clear boss at the top.
Right. But then you look at the U.S. insurance industry, and we are talking about an economic leviathan here, right?
Yeah.
Trillions of dollars in premium revenue. It literally touches every single part of our economy.
Every single part.
Yeah, but its ultimate centralized federal boss, like the big agency in D.C., it just doesn't actually exist.
It doesn't. And it's easily will cover the most astonishing structural realities of the American economy. You have this colossal industry underwriting, every car driven, every house bought, every business launched, and there's no single all-seeing federal agency running the show.
Which honestly makes it a massive regulatory puzzle. So welcome to this special edition deep dive for your insurance study companion.
Glad to be here.
Today, we are mapping out this sort of invisible architecture of the U.S. insurance industry. We're looking at the organization that is quietly coordinating all the chaos behind the scenes, and that is the NAIC.
Yes.
We're going to break down exactly what this organization is, why it matters so much to the survival of the industry, and critically, for you listening, how understanding this dynamic is going to help you crush your CPCU exams.
Because honestly, when you're staring down these advanced courses, trying to memorize all the nuances of insurance regulation, it can feel completely impossible.
Oh, totally. Like just a giant wall of random rules.
Right. It feels like random rules until you know who is actually pulling the levers. Once you understand the underlying mechanism, like the why and the how behind the regulations, the whole framework just clicks right into place.
So let's start by cracking open the acronym itself, NAIC. It stands for the National Association of Insurance Commissioners.
Yep.
And to understand how this massive industry functions across state lines, without a federal overseer, we really need to look at what this group actually is.
Well, the simplest way to define the NAIC is just to look at who sits at their table. It's an organization made up of the chief insurance regulators from all 50 states, plus the District of Columbia and, I think, 5 U.S. territories.
Wow, okay, so everybody's there.
Everyone. But the most important word in that whole title is association.
Right.
It is a non-governmental organization. It is not a federal agency. It is not a direct regulatory body. And it's certainly not an insurance company.
Which, I mean, that feels entirely counterintuitive when you first learn it, right?
Okay.
If they aren't a federal agency and they don't have direct regulatory power over the carriers, how do they actually wield so much influence?
Right. It's a great question.
Because I want to test an analogy here from the notes to kind of make sense of this for everyone.
Yeah.
Is it fair to think of the NAIC as like the rule book writer, while the actual State Department of Insurance acts as the referee on the field?
Oh, that framing works perfectly. I mean, think about how any sport operates. A rulebook writer doesn't carry a whistle.
Right, they're sitting in an office somewhere.
Yeah, exactly. They can't throw a penalty flag, they can't review a play, and they absolutely cannot eject a player from the game. The state regulator, the referee, handles all of that active enforcement.
Okay, I see.
But that referee desperately needs a comprehensively researched, standardized rule book just so they know what a penalty even looks like in the modern game,
Right, and because the U.S. relies entirely on a state-based system for insurance regulation, you essentially have 56 independent referees out there.
Yeah.
Every single state is just its own little regulatory island.
Yeah, and without the NAIC acting as the coordinating hub, the friction between those islers would just grind the industry to a complete halt.
Because everybody would have different rules.
Exactly. Imagine an insurance company trying to launch a new nationwide commercial product. If they had to navigate 50 completely isolated, contradictory sets of financial reporting rules and consumer protection laws, I mean, the sheer administrative cost would be astronomical.
Yeah, they just wouldn't do it.
Right. So the NAIC was created by the states, for the states, to sit together, pool their expertise, and figure out a consistent way to manage all this complexity.
Okay, so if the NAIC is writing this universal playbook to prevent all that administrative chaos, let's talk about what is actually inside of it.
Good idea.
Because the primary tools we see mentioned over and over in the study materials are model laws and model regulations.
Yes. And the mechanism behind how these model laws take effect is so crucial for you to understand for your exams. Because of state sovereignty, the NAIC has absolutely zero authority to mandate that Texas or California or whoever adopt anything.
Wait, really? So they can just say no?
Oh, absolutely. They can completely ignore it. The NAIC functions much more like an incredibly high-level R&D lab, right? They gather all their experts, they debate the nuances of an emerging risk, say, how to regulate autonomous vehicles or data privacy.
Right, the really complicated new stuff.
Exactly. And then they draft this comprehensive, highly detailed piece of ideal legislation.
And then they essentially just hand it over to the states and say, hey, we did the heavy lifting, we held the hearings, we ran the data, feel free to use this.
That is exactly it. The states then choose whether to run that model law through their own individual legislatures. Often they'll adopt it almost word for word, or maybe they just tweak it slightly to account for local, geographic or economic stuff.
Which makes sense. Florida's needs are different than Ohio's.
Right. But it saves the individual state insurance departments massive amounts of time as taxpayer money while still generating the uniformity that the whole industry really needs to survive.
Okay, so let's trace how that uniformity actually hits the ground on, a random Tuesday. Let's start where the money is made, pricing and underwriting.
Okay.
According to this architecture we're building, the NAIC standards promote consistent underwriting regulations. But how does that actually change the day-to-day job of, say, an actuary sitting at a desk?
Well, think about the sheer volume of statistical data that actuaries have to process to build their predictive pricing models, right? Oh, it's insane. Terabytes of data.
Right. So if an actuary is trying to price a multi-state property policy, and one state demands financial data submitted in an Excel spreadsheet, but another requires some proprietary software format,
Oh, man.
and then a third asks for specialized physical documents, that insurer would spend millions of dollars and thousands of man-hours just translating the data before they even started analyzing the actual risk.
Meaning that massive overhead cost just gets passed directly on to the consumer in the form of higher premiums.
Yes, precisely. And that is where the NAIC steps in to create a universal data language. By developing these standardized reporting formats, they dramatically cut those administrative overhead costs.
So everybody is finally speaking the same language.
Exactly. It allows actuaries and the state rate reviewers to seamlessly compare apples to apples across state lines, which ultimately supports fair market competition and, more accurate pricing for the consumer. But the rulebook doesn't just stop at the math and the actuarial data, right? Because the NAIC is heavily involved in the consumer protection end of the spectrum, too.
Heavily involved.
Yeah, like they publish model regulations on fair claims handling, they establish guidelines for preventing insurance fraud, and they standardize how customer complaints are even tracked.
Yeah, a great example of this in action is the market conduct examination.
Okay, let's talk about that.
So this is a really vital regulatory process where state examiners actively review how an insurer is treating its policyholders out in the real world. They're looking at the ground truth, like, are the marketing materials deceptive? Are claims being investigated and paid out fairly and promptly?
Which, again, has to be a massive undertaking for a single state department to figure out from scratch every single time they want to audit a company.
It is. It's huge. So the NAIC provides the states with comprehensive, standardized manuals and procedures for actually conducting those exams.
Oh, I see. They give them the blueprint for the audit.
Exactly. That way, a state department of insurance isn't just flying blind when they audit a multi-billion-dollar carrier. They have a really sophisticated, vetted framework. And it ensures that a policyholder living in a smaller state, maybe with a less funded insurance department, gets the exact same baseline of consumer protection as someone living in New York or California.
That is so smart. And that baseline of protection leads us right into the most critical function of the NAIC, I think. Because standardizing claims and underwriting is fantastic for day-to-day operations.
Yes.
But what happens when the sky falls? Like, we need to talk about financial regulation and solvency monitoring.
Yeah, solvency is the absolute bedrock of the whole insurance concept.
Right.
It simply means the insurer has the financial strength, the actual liquid capital, to pay out the promises it made to its policyholders. Because if an insurer goes bankrupt, the whole social contract of insurance just collapses.
Yeah, people lose their homes, businesses can't rebuild, the economic fallout is just devastating.
It really is. So monitoring that solvency across thousands of carriers is arguably the NAIC's most important contribution to the U.S. economy.
Okay, so let's break down how they actually monitor it, starting with the accounting itself. They use statutory accounting principles, or SAP, right?
Yep, SAP.
For anyone listening who's studying accounting alongside their insurance courses, you've probably seen this contrasted with standard corporate accounting, which is GAAP. So why do insurance regulators need their own special flavor of math?
Well, normal corporate accounting GAAP focuses on the ongoing dynamic value of a business. It kind of just assumes the company is healthy and will keep operating indefinitely.
Like a normal business.
Right. Statutory accounting principles, on the other hand, are hyper-conservative. SAP basically forces the company to ask a doomsday question.
Okay, what's the doomsday question?
It asks if this insurance carrier had to shut its doors tomorrow and instantly pay out every single claim currently on its books, do they have the liquid assets to actually do it?
Wow. Okay, so the NAIC creates this hyper-conservative accounting standard, and they bake it into this massive standardized financial report called the annual statement, which I know every insurer is required to file.
Yes, every single one.
So let's run a real-world scenario to see this sort of early warning system in action. Let's imagine an insurance company writes a massive amount of property coverage in a coastal region.
Okay, I can see where this is going.
Right. And they just get hammered by a string of unprecedented severe weather events. The claims are piling up, and they're bleeding cash at an alarming rate.
Right. And in a completely decentralized regulatory world, those state regulators might not realize how catastrophic the situation is until the company's checks literally start bouncing.
Which is way too late.
Way too late. But because of the NAIC framework, that company has been filing their annual statement using SAP. So regulators take that standardized data and run a specific calculation called the risk-based capital, or RBC ratio.
Okay, so the RBC is essentially like a financial blood test for the company.
It is, and it's a highly tailored one, too. The NAIC developed the RBC formula to determine the absolute minimum amount of capital an insurer needs to survive, based specifically on its unique size and the exact risks it takes on.
Okay, give me an example of that.
Well, a life insurance company that's primarily investing in very safe long-term bonds is going to have a very different RBC calculation than a property insurer writing hurricane coverage in Florida.
Right, of the risk profiles are just totally different.
Exactly.
But here is the tension point. The transition from the NAIC rulebook back to the state referee that we talked about earlier.
Yeah.
Let's say we run that RBC blood test for our struggling coastal insurer, and the results come back deep in the red.
Okay.
Their capital has fallen dangerously below required levels. The NAIC built the radar that detected the danger, but they can't actually do anything to stop the crash.
Right. This is exactly where the rulebook writer hands things over to the referee. The NAIC framework sounds the alarm, but the state insurance department, the actual regulator with the jurisdictional authority, is the one that has to step in and demand corrective action.
So depending on how bad that RBC ratio is, the state DOI can mandate a strict remediation plan.
Yep.
And if the financial hemorrhage doesn't stop, the state regulator is the one who initiates the enforcement actions. Right. Ultimately, placing the insurer under supervision or taking over the company in a process called receivership just to protect the policyholders.
Yes, and the synergy there is really what makes the entire U.S. system function. The states possess the legal authority to seize a failing company, but they rely entirely on the NAIC's incredibly sophisticated data modeling and capital standards to know when to seize it before it's too late.
It's honestly brilliant when you see it all laid out like that. The states bring the enforcement authority, the NAIC brings the architecture. And now that we've mapped out how this actually works in practice, we really need to make sure this translates into a passing grade for your upcoming exams.
Absolutely. Because whether you are diving into CPCU 500 on managing evolving risks, or looking at insurance operations in CPCU 520, or even tackling the complex legal and regulatory frameworks in CPCU 530, the NAIC is a cornerstone concept.
It really is.
It will keep appearing in your coursework, and you have to know how to navigate it.
Not to mention the foundational AINS and AIC courses, too, for those of you taking those. Test writers absolutely love this topic because it is just ripe for traps.
Oh, they love a good trap.
They really do. And the most common pitfall candidates face is that the sheer magnitude of the NAIC's influence makes them look like a federal agency. You'll be taking a multiple choice test, and they will throw in a distractor option that presents the NAIC as a branch of the federal government.
Right, or the question will subtly imply that the NAIC can directly sanction an insurance company, or issue a fine, or revoke a license.
And if you pick that,
you get it wrong. Both of those scenarios represent a fundamental misunderstanding of the U.S. regulatory system.
Right. So to keep this straight, when you're actually sitting in the exam room, there's a really clean mental bucket system you can use.
I love this system.
Yeah, it's great. Picture two separate buckets on your desk, right? In the NAIC bucket, you put standards, coordination, and data. In the state DOI bucket, you put licensing, regulation, and enforcement.
Perfect.
If you just look at the action verb in an exam question, you'll immediately know which bucket to pull your answer from.
Let's test that bucket system with a scenario rather than just reciting definition.
Okay, let's do it.
Suppose an exam question poses this situation. An insurer is found guilty of systemic, unfair claims practices. Which entity is responsible for suspending that insurer's certificate of authority? How would you reason through that?
Well, looking at the verbs.
Mm,
Suspending a certificate is a direct enforcement action.
right,
It is actively penalizing a company.
right.
And enforcement goes in the state DOI bucket. So the answer must be the state insurance department.
Spot on. Now let's flip it. What if the question asks, which organization develops the procedural guidelines for conducting the market conduct examination that uncovered those unfair claims practices in the first place?
Develops the guidelines. That means creating standards and frameworks. And standards belong in the NAIC bucket. It's really that simple when you separate the creator of the rules from the enforcer of the rules.
And understanding the why behind that separation prevents you from second-guessing yourself under exam pressure. The NAIC doesn't want enforcement power. Their mission is purely about elevating the capacity of the state regulators through shared data, universal model laws, and these rigorous financial solvency standards.
It's kind of the ultimate group project, right?
Yeah.
But one where the stakes are literally the financial security of millions of people.
Very high-stakes group project, yeah.
Right. But by pooling their expertise, state commissioners develop far more sophisticated protections than any single state could likely afford to build on its own. So as we wrap up this deep dive into your insurance study companion materials, we want to leave you with a really concise summary. The golden rule to take away here is the states regulate insurance. The NAIC helps the states regulate it consistently.
Yes, that is the perfect summary. And as you continue working through your courses, I want to leave you with a thread to sort of pull on and think about.
Oh, I like a good lingering thought.
Right. Well, we've established today that the NAIC relies purely on individual states choosing to adopt their model laws. It is a regulatory system built entirely on consensus, debate, and voluntary legislative action.
Which, by its very nature, is a process that takes a considerable amount of time. You have to get 50 different legislatures to agree on something.
Exactly. And it brings up a fascinating structural question for the future of the insurance industry. How will a slow, deliberate process of state-by-state legislative evolution handle the incredibly rapid emergence of complex, modern risks?
Yeah.
I mean, think about global cyber warfare or the escalating, totally unpredictable impacts of climate change. These are risks that evolve in a matter of months, not years.
Right, and they certainly don't respect state borders. A cyber attack doesn't stop at the Nevada line.
Exactly. So the question is, will the NAIC's current framework of voluntary model laws be agile enough to keep up? Or will those massive borderless threats eventually force the conversation about a centralized federal regulator back to the table?
That is a brilliant tension to keep in the back of your mind as you study, because the industry is never static, and understanding this foundational regulatory architecture is really the only way to anticipate where the next big shifts are going to happen.
Absolutely.
Well, thank you so much for joining us on this deep dive. Keep up the phenomenal work with your studies. Trust the bucket system. Remember who the referee is, and we'll catch you on the next one.